There are moments in markets where nothing dramatic happens on the surface, yet everything underneath is changing. This is one of those moments. Rates haven't collapsed. Stocks haven't crashed. The financial system hasn't broken in a visible way. But confidence is quietly shifting. And when confidence shifts, gold and silver start behaving differently. Not explosively, not emotionally, but intentionally. Today's video isn't about predictions. It's about positioning your thinking for the next phase. Because the Federal Reserve is entering a very different era than the one we've just lived through. An era defined not by control, but by limits. For the last several years, the Federal Reserve was predictable. Inflation rose, the Fed tightened. Rates went up. Liquidity was drained. Markets complained. But they adapted. That predictability is now gone. The Fed is no longer fighting inflation from a position of strength. It's managing the damage already done. And that's a crucial distinction. High interest rates don't just slow inflation. They expose weak balance sheets. They pressure government debt. They strain banks, credit markets, and refinancing cycles. The effects of tightening lag. What we're seeing now is the delayed impact of policy. Decisions made years ago. And here's the uncomfortable truth. The Fed knows this, which means every decision going forward carries more risk than the last one. Cut too early. Inflation, credibility collapses. Hold too long, something breaks. This is not a confident policy-making environment. It's a defensive one. And gold does very well. When policymakers are defensive, gold is not panicking. That alone should get your attention. Gold is holding ground, absorbing volatility, refusing to collapse. Despite rising real rates at times, that tells you something important. Gold is not reacting to headlines, it's reacting to structural uncertainty. Silver, on the other hand, feels chaotic right now. Sharp moves, sudden pull, violent rallies that fade. Many people read that as weakness. It's not weakness, it's tension. Silver sits at the intersection of monetary distrust, industrial demands, supply constraints, and speculative positioning. When the system is stable, silver underperforms. When the system destabilizes, silver overreacts. That overreaction is uncomfortable, but historically, it's the prelude. The difference this cycle: silver is responding earlier than it usually does. That suggests markets are not just hedging inflation, they're hedging system fragility. There was a time when CPI alone moved markets. Now CPI is noisy. Dobbs data is inconsistent. Revisions are frequent. Participation rates matter more than headlines. The Fed isn't reacting to one data set anymore. It's watching stress signals, credit, spreads, liquidity demand, bond auctions, funding markets. Gold understands this better than equities do, because equities need growth optimism. Gold only needs doubt. Silver feels this tension more violently, because it lives closer to economic reality. Factories, energy, electronics, infrastructure. Silver doesn't need collapse to move, it needs disruption. And disruption is exactly what unclear data creates. People are waiting for a dramatic moment, a headline, a panic, "this is it" event that may never come. The next shift is likely to be quieter, slower refinancing, higher rollover risk, selective failures instead of system-wide collapse. That environment favors hard assets, liquidity optionality, pernicious leverage, and overconfidence. Gold thrives here because it doesn't require growth. Silver struggles first, then accelerates when stress becomes undeniable. That pattern has repeated across cycles. Equities tell stories. Bonds tell truths. Weak auction demand. Rising yields despite slowing growth. Increased term premiums. These are not bullish signals for stability. They're signals that trust is being repriced. Central banks. See this? Why gold accumulation continues quietly, even as public messaging downplays concern. Institutions hedge quietly. Retail panics loudly. History rewards the quiet. Silver's supply picture is tighter than most people realize. Industrial demand isn't optional, it's structural. Solar, electrification, defense, medical. Substitution is limited. Mining expansion is slow. That doesn't eliminate volatility. It delays recognition. Silver often looks broken, right? Before it, I isn't single quotes T. The emotional swings scare people out right before structure takes over. This is not the time for emotional positioning. It's a time for sizing, correctly understanding volatility, separating paper price from physical reality. Physical metal holders have time on their side. Paper traders must respect volatility. Now the approach is wrong. Confusion is the mistake. Is expecting calm returns during unstable transitions. That's not how cycles work. Watch. Real yields, not nominal bond demand, not stock rallies, central bank balance sheet, language silver's reaction to pullbacks, funding stress indicators, import daily noise, emotional commentary, extreme prediction structure matters more than sentiment. The Fed once moved markets with confidence. Now it moves cautiously. That tells you everything. Gold recognizes limits. Silver reacts to tension. And investors who survive cycles don't chase certainty. They prepare for ambiguity. The next era won't reward speed. It will reward patience. Credibility. LA&I based on recent Federal Reserve communications, CPI, and labor market data. Bond market behavior. An ongoing analysis of precious metals performance. This discussion outlines the developments likely to shape gold and silver through the first half of 2026.